Despite the virus, a new World Bank report predicts that Africa will be one of the fastest growing regions over the next couple of years. Rachelle Akuffo spoke to the World Bank's chief economist for Africa, and they talked about how that continent is bucking the trend of weak global growth.
Africa's been able to buck that trend in two ways. On the one hand, in a number of cases, it's increased the volume of production of natural resource commodities. So even though the prices have fallen, the increases in volume have more than compensated for it, and the economies have been able to sustain their growth. Another thing that Africa has done is to diversify a little away from natural resource dependence exclusively and towards a faster growth, for example, in the services sector, which, for example, now contributes more to the Nigerian growth than oil and gas do.
Now, we're seeing this move away from agriculture and manufacturing to natural resources and services. Is that a good or a bad thing for the African continent?
It's a glass half full, right? The half full side is that services is growing. It's a productive sector. It's a sector that we find in our analysis is actually quite good at reducing poverty. Not all growth reduces poverty in the same way. And growth in services and in agriculture help reduce poverty. So that's a good thing about service sector growth. Now, the part of the glass that's half empty is manufacturing, where we think Africa is still below potential. It's now under 10%, the average share of the economies in manufacturing in Africa. And we feel it could be much higher than that. So by providing reliable and affordable power, by reducing transport costs, by reducing border transaction costs, by promoting more regional integration, for example.
What are the kind of fiscal policies that you think need to be put in place to make sure that growth is inclusive, high-quality growth? Sure.
I mean, on fiscal policy, two key things. One, to respect the overall envelope. One of the risks we see, one of the clouds on the horizon that we see is in some countries a tendency to let fiscal deficits grow a little bit too large, above 6–7% of GDP, and that you need to address. But within that envelope, there is scope for more redistribution, right? So we talk about a two-part strategy for making growth more inclusive in Africa. One, factors where the poor are, but two, harness the power of growth detector and make some transfers, some redistribution to poor people.
Let's look at Africa's two biggest economies, because we're seeing two very different stories there. With the biggest economy, Nigeria, we're seeing strong growth, but with South Africa, we're seeing a slowdown.
Yeah, they're very different economies. Nigeria is growing strongly, particularly actually in the non-oil sector. The strongest part of the growth in Nigeria is in services. There's also growth in manufacturing in Nigeria, which bucks the trend regionally a little bit. South Africa has been hampered a little bit by some old structural issues around its labor market. It has a very high unemployment rate.
We're seeing growth, but it's not translating into job creation. Where do you think there's a disconnect?
Part of the disconnect is because of the sectoral composition that you've already referred to. So quite a lot of Africa's growth is still in the natural resource sector. And natural resource-rich countries have grown faster than other countries in the last 10 to 15 years, quite a bit faster. That growth, by virtue of the fact that the natural resource extractive sector is more capital intensive, does create fewer jobs. And so the economies have to respond to that. And that explains in part the shift towards services in those economies.
What are some of the low-income countries that you're seeing with the strongest potential?
Real success stories, countries like Ethiopia, Rwanda, that have grown at very rapid rates, 6–7% per annum, even without a natural resource sector that's very intensive. So that's actually growth from services, agriculture, and to a smaller extent, manufacturing.
Now, China's actually become Africa's largest single commercial partner. How do you think that's going to impact the African economy in the long term?
Well, you know, it's an increasingly important relationship. And as you say, China is now the most important trading partner for many, many countries in the region. Mostly, I think that has been, you know, a huge force for good. The Chinese demand for commodities has helped keep the commodity markets buoyant for many, many years. That has helped African economies in an enormous extent. China has also become a big investor in a number of different sectors in the African continent. There's large investment in infrastructure by Chinese companies, including state-owned companies. There's also quite considerable investment by private Chinese firms, for example, in manufacturing in Ethiopia. So it's a very strong partnership. It's a good South-South relationship, which, you know, as with any relationship, there are occasionally problems and needs to visit issues, but on the whole, I think it's a very important linkage that benefits both China on the one hand and Africa on the other.
And that was Rachelle Akuffo with Francisco Ferreira, the World Bank Chief Economist for Africa. Thank you.